everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Amazon.com Inc., ticker AMZN. It's been about a year since we last took a look at them, and last time we came up with the fair value right around $150 and a average annual growth of 12 to 13%. So it's a pretty similar case here. Looks like the fair value has grown about $10 and the average returns have dropped a little bit. Let's take a look and see if this thing is worth buying. Valuation is incredibly high. Earnings yield of 4.66% for what you're paying. This $220 that it's currently trading for, you'd want to see somewhere around $11 EPS. I mean, maybe a bit lower if you want to give this a bigger multiple, but it's definitely not there. This last year, 566. This year, 621 is expected, and next year, 729. Definitely not the 11 that we were looking for. Cash flows, the yield is up. We can take a look at the graph, and the cash flows are looking a whole lot better than they were, of course, back in 2020 and 2021 and 2022. They were negative. Not too much growth from 23 to 24, though. That is something that is a little concerning for the cash flows. We'd like to see them grow that a lot faster. I mean, they're now yielding 5%. 10% would be ideal, but their margins aren't even 10% yet. Probably not going to see that anytime soon. And when I run the numbers for discounted cash flow, coming up with $99. So cash flows are definitely something that is holding them back. When I run a residual income model, I am coming up with about 163, which is a lot better, closer to the fair value that we're seeing. So their income is good, but their cash flows are not. And likely a big culprit for that is the stock-based compensation. I mean, you can see their net income here, stock-based comp, good chunk of that, over a third of it, which is likely why we see their share count growing, because they're issuing shares to their employees. And that is diluting shareholders. It actually grew in this last year when there were more shares existing. So they issued a pretty significant amount this last year, which is why it didn't live up to expectations and our annual returns are down, and is a big reason why that's one of the big warning signs not to invest in a company is they're issuing shares. ROE looks pretty good. Debt to equity isn't too bad. That could definitely improve the balance sheet a little bit, but when you look at the assets and the liabilities, things are trending in the right direction. Shouldn't be too long before we see a decent balance sheet from them. ROI, a little low, 6%. I mean, we'd like to see that at least 8%, right? And then ROA, 9.5%. Double digits would be nice. Gross margin, super strong, 48.9%, up from their average of 45.4%. Net margins, 9.3%, up from their average of 5.3%. So margins are trending the right way. And then we have another obvious sign that the earnings front is very overvalued. A PE ratio of 35, earnings growth rate of 17.4, which gives you a price to earnings growth of 2, twice what we look for. Definitely a very overvalued stock. $63 for the RIM is pretty good, probably one of the better cases. I mean, if we go look at the metrics, if you trade it strictly off earnings, looking for a 30 PE, this year, 186 would be decent, and next year, 220. So it's really trading at valuations 2 years out based on solely the earnings. You know, the financials have a decent trend. COGS are staying relatively flat while the revenue grows, which is nice. And then we have the EBIT is the most important thing here. Dipped down in 2020, is on its way back up. Hopefully it continues that upward trend. Balance sheet, we talked about how it could use some improvement, but it's on the right path. Assets definitely are looking good. Liabilities a bit flatter, 350 peak here. So that would put the liabilities in comparison to the assets right about in this area. So not too bad. And they do have a tangible assets and a tangible book value, which is something that we do look for. Cash flow wise, I mean, they've turned things around. We'd like to see more growth because there was not a whole lot this last year. From 32.2 to 32.9, that's nothing. Significantly better than what we've seen previously. but that's not the type of growth that is baked in for the valuation that it's trading for. Then when we look at everything graphed out, cash flows had some decent improvement, but like I said, they kind of flattened out. Balance sheet seems to be on a decent trend, and the fair value is on a nice trend up with it. But with our thesis, it's flattening out a little bit. Actual share price this last year was decent. 120 was their average open with a fair value of 131. And then earnings is just growing up past everything else. Well, actually, at the moment, the share price is outpacing everything. Looks like 186 for the earnings. So I think best case scenario, something in the range of 160 to 180 would be a fair value for this. I do expect it to come back down unless they can really improve on those cash flows. I had mentioned the thesis for there. Things are pretty obvious. I mean, 9% is definitely what analysts have baked in annually for growth in the revenues. Share count, I could probably raise this a bit. Hopefully they don't continue to go past 2% and on. Cash flows, 9.5 actually improves over time if they're bringing in revenue growth of 9%. So it'd bring the cash flow yield up to 5.3 in the next 5 years. And we could improve on this, but they didn't have much growth this year. So we'll come back to that. Assets, they've had massive growth. It's likely to slow down. And this is the compound annual growth rate over the next 3 to 5 years. Liabilities, clearly in the almost 5 to 6% range. No dividend as of yet. And margin growth, we'd like to see them get up above 10% in the next 5 years. So let me adjust this a little bit. Take this 1% up to 1.5. Gets them to 10% exactly in 5 years. So we had talked about the cash flows. I think stronger margins will help with this. If we do 11% growth, so it's 2% over the revenue, they're still only bringing their yield up to 5.6. So they need some pretty good growth in these cash flows to really make a movement. And you can see how this is impacting the annual growth down there. So 25% finally gets them up into double digits, takes them from 12 to 14% returns. And it's obviously trading somewhere around a 4-year out valuation. No surprise, it is a well-known and very large company. I'd like to see a pullback, and honestly, I wouldn't be too mad about getting in at 180 because of how it has turned things around. I'd really like to see improvement on those cash flows. And if it does come in at that 25%, then our discounted cash flows grows to 108 from 99. So that was a $9 improvement in the valuation based on those cash flows. And it brought the overall fair value up to 164. And that is all for this one. I don't hate it. It's definitely trading at a very elevated valuation. The cash flow, slow cash flow growth, and the growing share count is definitely a concern. But other than that, things are trending in the right direction. And you're looking at market-beating returns, even with kind of the smallest case scenario. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.